we've got a lot to cover because there has been some big development affecting Toronto real estate just as September rolls around. The big one, of course, was the Bank of Canada's rate announcement this morning. The consensus was that there would be no rate hike, and they were right this time. But there's more to it than that, and in this video, we'll be diving into the changes that's been happening in our economy and then weigh all of these effects on Toronto real estate. So stick around and keep watching. After a weakness in the US jobs data and Canada's GDP last week, the chances of a rate hike dropped down to 7% before the announcement. Note that this comes in after the stronger than expected CPI that previously raised interest rate expectations, but if you drill it down, you will see that a big part does come from housing inflation, which is a direct effect of rate hikes. This ends up also showing in the GDP data, with the biggest downside in the GDP coming from housing investment, including both new construction and renovations. So basically, with higher home expenses and weaker spending, things seem to be moving in the right direction for the Bank of Canada, and we might continue to see delayed effects show up in data in the coming months. Now, on top of this, both the BC Premier and Doug Ford in Ontario have called for a halt in rate hikes. So all of these factors are supporting a potential peak in interest rates. And in fact, 31 out of 34 economists predicted that there will be no rate hikes in September. And as we've seen, they were right. Now, looking ahead, 26 out of the 36 economists say that there will be no more rate hikes for the rest of this year, with only 8 predicting otherwise. Either way, we are probably pretty close to the peak for interest rates, although we can't expect interest rates to come down anytime soon. Now, given that interest rates are expected to remain high for a while, and we are seeing negative effects happening to our economy, how will these effects negatively impact the housing market? Well, high interest rates have a delayed impact, and we don't know the full extent of their effect yet. Now, cracks do take time to show, especially as holding power will continue to weaken over an extended period of time with higher rates. There's also the fact that mortgage renewals are still pending, and we will continue to see these mortgage payments switch over to higher rates throughout 2024 to 2026 if they entered the market with rock bottom interest rates in 2020 or 2021. Next, we are seeing gloomy GDP data and weaker jobs numbers. So if this ends up in a recession for Canada, this will naturally affect buying power too. And we expect more of it to be targeted for investors moving forward. What we're seeing most recently is that banks are lowering their loan to value ratios for some investors from 80% to 75%. Now, if investors can't borrow enough to invest, this will further limit price growth on the real estate front. Now, on the flip side, there are also a lot of positives for our housing market. We've witnessed slow new housing growth from the GDP data, and that's just going to keep putting upward pressure on home prices given our high immigration targets. And the quickest way to see this is to see how much rents have been ballooning over the past year, over 25%. Now, on top of this, if we are close to peaking rates, then this is typically good news for real estate prices, since they do tend to move inversely with each other. The market has already adjusted downwards approximately 20% from the peak because of these high interest rates. So from an investment standpoint, new investment purchases in Toronto look pretty good, even at current interest rates, because prices are now much lower and rents are much higher. If history does repeat itself like it did in March when interest rates held stable for the first time in a year, we can expect to see support for real estate prices in Toronto. I do think that our market will still be relatively balanced, nowhere as strong as it was in 2020 to early 2022 when rates were at an all-time low, but we should still likely see more buying momentum from Toronto real estate this fall. The price recovery is probably going to be uneven, with better upside in the freehold rental market in Toronto because the numbers just work so much better. Right now, you can get cap rates close to 7% and over $1,000 in positive cash flows, even at 6% interest rates. The key here is that investing in freeholds does align with the government's goal for more affordable housing. Keep in mind that the government isn't focused on keeping prices low, but rather making rentals more affordable. And making more smaller units in a house can definitely help with this, and this ends up being a win-win situation for everyone. What we're seeing these days is more investors wanting to do this and coming to Toronto because of better multifamily home policies and just better growth potential here in the city. And if you want to explore investing in multifamily homes in Toronto too, we're your team. We're your real estate sales brokerage that focuses on investing in freeholds in Toronto, and we'd love to help you learn more about these opportunities. Just take the first step to book a Zoom discovery call with us. If you found this video helpful, show your support by giving this video a thumbs up and hitting that subscribe button to stay updated with our content. Our channel covers a wide range of real estate and investing topics in Toronto, from market trends to housing policies, interest rates, and investing strategies. We want to make your real estate and investing journey easier for you, so we offer services like planning, analysis, buying and selling, renovations, leasing, and property management. For more information, visit our website or find us on social media. Thanks so much for watching, and I'll see you in the next video. Bye.